So despite a patchy vaccine rollout, despite, really upheaval when it comes to the pandemic still being felt across the region, that export, the demand side is still very strong.
Indeed, we're still seeing quite strong on the industrial side, exports. Asia, particularly North Asia's supply side is open, and global demand for goods is there as other countries still are emerging from the pandemic. That's been very supportive for China and the rest of North Asia. We think we're probably seeing the peak of that and going to see more gradual export growth going forward, but it continues to be a source of strength for the region.
What does that mean for the overall inflation outlook, particularly as we're quite clearly dealing with, a renewed sense of hawkishness at the Fed and other central banks as well?
Really, the pace of demand growth and supply reopening has differed around the world, and that's driving a lot of the differences you're seeing in inflation around the world. Places where you've got more stimulus on demand, you're tending to see more reopening price pressures, places like the United States, and places where you've had more COVID difficulties, still virus-related controls, the supply side is more constrained. So the combination of those two things, I think, is driving a lot of the differences. North Asia, in contrast, done a pretty good job containing COVID and not done as much in the way of aggressive stimulus. So you're generally seeing pretty low inflation still, notably in China, but also broadly in North Asia.
Does that mean
other parts? Yeah.
Does that mean that we could actually see some of those first central bank liftoffs in Northeast Asia?
We do. We think Korea is probably going to be the first. South Korea is going to be the first to lift off. We think in the beginning of Q4. That reflects moderate inflation, very strong growth, and concerns about financial stability, particularly in the light of high and growing household debt. So we do think we'll see a rate hike there in the fourth quarter. Most of the rest of the region is likely to wait until 2022. Effective rates could move higher in some countries like India late this year as liquidity becomes less ample, less robust. But in terms of actual policy rate hikes, we think that's really going to be a 2022 phenomenon in most countries.
Andrew, sorry I cut you off earlier, but I think you were going towards Southeast Asia. We do have a couple of rate decisions there. What are you seeing for the region?
This week should be pretty quiet. To the extent that some countries might have hoped to provide a bit more stimulus, I think the slightly more hawkish tone from the Fed would put that off. We didn't anticipate rate cuts there, but we also don't think rate hikes are imminent because COVID control is still a challenge in a number of these economies. COVID news has been better. I think it's important to emphasize. New cases are coming down almost everywhere in the region, but virus-related restrictions are still somewhat elevated in India and Southeast Asia, and that's constraining the recovery. That will probably improve as we get further into the second half of the year. We see faster vaccinations, lower COVID, and we can see those restrictions come off and growth reaccelerate. That'll open up the possibility for rate hikes in 2022, but we'd be surprised to see a lot of tightening this year in Southeast Asia.
Andrew, how much distortion are we seeing when it comes to the recovery in labour markets, right? I'm thinking specifically with the fact that, international borders, the flow of people, the flow of goods is going really well, but the flow of people is not really happening, right? Do we see some sort of adjustment structurally when we really are out of the pandemic?
So if you're speaking of migrant workers, certainly it's been harder to see those kind of flows of people during the pandemic, although we still see flows, for example, of remittances from migrant workers from their working countries back to their home countries. So those have held up reasonably well considering the huge disruptions caused by the pandemic. We do think flows of people, flows of tourism, as well as labor are going to take well into 2022, if not beyond, to fully recover. Travel restrictions are really one of the last things that are going to come back. Even in countries that are doing a very good job controlling COVID, they don't want to reintroduce infections until they have much higher levels of vaccination. In that regard, There is positive news. Vaccinations are accelerating, particularly in Northeast Asia, and also in Australia and New Zealand. We're seeing some more progress there, but we will likely not reach what people would call herd immunity, or at least levels consistent with very high levels of vaccination, until late this year.
And Andrew, of course, we are expecting the loan prime rate out of China today. What are you expecting on that front?
We think monetary policy is going to be stable in China this year, broadly speaking. So we're not expecting changes there, not expecting significant changes. Policymakers in China have been tightening in some areas, but more what I'd call micro tightening, industry specific or sector specific tightening, whether that be property regulation, efforts in financial sector or fintech, environmental controls to try to reduce pollution that ultimately have some macro tightening effect. So given that export impulse that we talked about earlier is probably peaking, and the policymakers are already taking steps in some sectors to tighten policies, we don't expect to see a broad-based monetary policy tightening in addition to that.
And Andrew, hold on a second, because we have breaking news at the moment. The U.S. 30-year yield below 2% for the first time since February, dropping to 1.44 or so when it comes to the 30-year yield, or at 2%, in fact. And at one point, we had the 10-year yield also dropping to the lowest since March as well. That would be the 142 level that we're talking about. Andrew, give us your reaction to what's happening to Treasury yields and the implications for Asia as well.
The market seems to be taking the Fed's message that it could start hiking earlier as a message that it won't ultimately need to hike quite as much. So prior to last week's meeting, Fed FOMC participants hadn't been predicting any rate hikes in 2023, or the median participant hadn't been. Now they're predicting 2 rate hikes in 2023. Still a lot of uncertainty around that, as Chair Powell emphasized. But insofar as the Fed starts its cycle earlier, that means it's less likely they would get behind the curve, and less likely they might have to tighten more rapidly or more dramatically over the whole cycle. So I think the market is seeing this as a trade-off between hiking earlier versus hiking more cumulatively. And that's brought the back end of the curve down. And that's generally been good for longer dated assets, obviously things like tech stocks. I think and from the perspective of Asia Pacific, I think maybe taking out some of the worries again about a very rapid or prolonged hiking cycle. It's been short-term positive for the U.S. dollar, and that could perhaps extend a bit further. But our global views are that we will not see a prolonged dollar appreciation. Fundamentally, the world is still recovering. Many parts of the world are recovering. Fundamentally, Fed policy, we shouldn't confuse this with a really hawkish policy. This is just a bit less dovish than it seemed a week ago. So we think the fundamentals for a weaker dollar over the next year or two are still there.